What's going on, everybody? It's Brian Trippe. Welcome to another episode of the Real Estate Investing Live podcast. I'm located here in Birmingham, Alabama, and I'm so glad you decided to join us today. We have a great guest, like we always do, the founder of Norada Real Estate Investments, the host of the Passive Real Estate Investing Show. We have Mr. Marco Santarelli with us. How's it going today, Marco?
It's going great, Brian. I love being on your show. How are you doing today?
I'm doing well. I've been following you for a while. I know what you do. I know who you are. And I want to get our audience an opportunity to get to know you as well. I'm confident most people have heard of you and know who you are, know what you've done. But for the few that don't, Marco, kind of start us off by telling us a little bit about who you are and how you got into real estate. I know you got into real estate at a really young age too. So tell us a little bit about your story, how you got into real estate.
Yeah, long story short, I just decided to invest in real estate at a young age. I just knew as a teenager that wealth was created around me by the people that I saw and people that I knew in my family, my family's friends, that they were investing in real estate. So when I turned 18, which was the minimum age to qualify for financing, I bought my first townhome rental, fixed it up, managed it myself. I stuck a sign in the lawn. There was no internet back then, so you couldn't advertise online. But basically, I just did it through all signage and paper. But that was the time when the writing was on the wall. You know, it's like history was set for me. My path was set, and I just followed that through. I got my real estate license. I did sell real estate for a while, but you know, you fast forward through the years, I can continue to invest in real estate. The big year was actually in 2003, 2004. In a 9-month period, I actually acquired 84 doors in 9 months, mostly single families, duplexes, and fourplexes, and I did all that from 3,000 miles away. I was living in Southern California, or what I jokingly call the Socialist Republic of California. Okay. And and I was investing in, Florida, Georgia, Michigan, Ohio. And I made my fair share of mistakes. And I lost a lot of money, but I made a lot of money. So those lessons learned are what you use to build yourself and take yourself to another level. But in sharing those with you and your audience and other people now, literally almost on a daily basis, is what I enjoy doing. So yes, I'm an investor. I'm an entrepreneur. I like to teach, as you do. I'm a husband, a father, and I just love doing what I do. And I'm jazzed every day to be able to do this.
It's awesome. Marco, what year was that? You were, and I'm not trying to give away your age, but what year was that when you got started?
It was, I was 18. So let's see, add 69 to 18.
Okay. Or you just gave away your age. So
I did. So that would be 86? No, 87.
So you got into real estate in the 80s, and you said something that's really fascinating when you first started talking there about that, your family, you had some friends that were invested in real estate. And you said your path was kind of laid out for you. Well, I know a lot of people whose parents were in a profession and very successful, and they wanted to do the exact opposite of what was successful, quote unquote, successful in front of them. Why did you, was there a deeper reason? You just saw success and you just want to follow the path? Most 18-year-olds want to be a little bit rebellious and do the opposite.
Yeah, I think most teenagers and even most people in their 20s really don't know what they want to do. They think they know what they want to do, and they're being told what they should do. And a lot of parents want to be proud of their kids, and they tell them, get a high-paying professional job, be a doctor, lawyer, dentist, something that we all look up to, a profession that's on a pedestal. The problem with that is most people don't really engage with that. They don't really want to be what they're being told to be, and they are confused. They don't know what all the options are that are out there. If you look at all the things you don't know, it makes up the greatest percentage of a pie. What you don't know, what you don't know. And then there's a small slice are the things that you know that you don't know about. And then the smallest slice is the things you do know. So how could an 18-year-old or a 20-year-old, even a 25-year-old that's going to college and university know what they want to be doing and for the rest of their life? And that's why so many people start going down a career path and then end up changing, is they realize that what they thought they wanted to do for whatever reason, maybe for the money or for something else, is not what they are passionate about. It's not what they enjoy doing and getting up every morning to do. I went to university and I took criminology. So I went down the sociology path, specializing in criminology because I thought I wanted to be a police officer. Well, as I started going down this path, I realized, well, number one, they don't make as much. They got paid well. They do get paid reasonably well, but not as well as being another kind of professional, or being an investor, or being a business owner, or anything like that. So I never did pursue that. I finished schooling for it, but I never pursued it because I realized in my heart of hearts that I really wanted to be free. I wanted to be an entrepreneur. I wanted to create wealth. I wanted to create passive income, which is financial freedom, which leads to time freedom. And everything I just said here in the last 10 seconds is the reason why I do what I do, including the podcast, is to show people, help people, teach people how to create that financial freedom so they have that time freedom. And the best vehicle to do that with, as I discovered long, long ago, and I still firmly believe today even more so, is investment real estate. Done right, it is the best wealth creating tool and investment that you can get in this country, and for all intents and purposes, the world.
So let's talk about that. Let's go down that road. You mentioned you have a podcast. You mentioned, or you didn't mention this, but I read this in your bio that you're a broker. You've been doing real estate for a very long time, Marco. Tell people what you do specifically today.
Specifically, my company that I started over 15 years ago. I forgot. It was early January 1990 or 2000. Oh man, time flies. 2004, January 2004. So what we offer, what we do is this. We are a nationwide provider of turnkey rental properties. Why? Because it is with turnkey cash flow rentals that you can truly create wealth passively and create a passive stream of income and build true legacy wealth. So you have income and financial freedom for you and your family today, and you can carry that forward and create generational wealth. So that's what it's all about.
And you do that through your podcast, or you said you teach, you love to teach. You do that just through communication means is how you get that message out typically. Tell like, kind of like layer your, how much is it brokerage? How much is it teaching and educating, podcasts? Like, where is it all how's it all break down?
Yeah, I didn't know you wanted me to get into that much detail.
I'm just curious because I think it's really interesting. You're doing a lot of what I'm doing, and I probably followed a little bit in your footsteps and some other people's footsteps that came before me, because I have a very similar background to, I was doing turnkey for a while because we're in a cash flow market. By the way, we're going to talk about turnkey here in a minute. But I'm just curious of your path, your career trajectory has kind of led you to this point. You said you did a lot of real estate, bought all those houses in a very short period of time, and then now you're at this stage where you're just providing these turnkey properties. That's your core business, it sounds like.
Yeah, so there's two websites, the Norada realestate.com. That's where we put all our properties. We'll have anywhere from 100 to 200 properties available, ready for sale, tenant occupied, cash flowing positive today at any given time. They come and go, and we don't post all the properties on the website because a lot of them don't even make it to the website. They just go under contract or whatever. And then passiverealestateinvesting.com is the home of the podcast. So they're really sister websites to each other. They both are content rich. They have free downloads. We have a free book coming out here very soon. There's just tons of free content. Everything we do is essentially for free. We don't charge for anything, which I know from a marketing perspective is probably a mistake because there's nothing in the middle. It's basically free content, teaching, counseling. And then when you're ready, we've got turnkey rental properties available in 22 markets around the U.S. Now, these markets are mostly in the Midwest, the South, Southeast, and a couple markets in the Northeast. Why those markets? Because the numbers make sense. Alabama is a state where we're in 3 markets, and you know exactly why, because the numbers make sense. It's a landlord-friendly market. There's a lot of inventory. There's good fundamentals and stability in that housing market. This is why we pick the markets we pick, is because from an investment perspective, it makes sense. So I've trademarked the saying, live where you want, invest where it makes sense. And I trademarked that saying because that's the motto we follow, is to be market agnostic. So even though I'm in Southern California, doesn't mean I do anything in California. I wouldn't touch California with a 10-foot pole. It's just from a real estate investing perspective, it just doesn't make sense. And that's true for many markets around the country right now.
Yeah. Let's keep going down this path, because I think that there are a lot of people who listen to the show that are either turnkey investors or they're cash flow investors. And this show started as an Alabama specific podcast, and we kind of expanded that about a year ago to make it more national. But our core base, I know, newer people and people who understand cash flowing markets. So let's start there. You said the question, why these markets? Why are we in the Southeast? Why are we in the Midwest? Why are we in a couple of the markets in the Northeast? Why are we in these? Because the numbers make sense. Marco, what does that mean specifically?
So you can't look at a property in isolation. You can't just invest in a rental property because of the numbers alone. There's a bigger picture, which we can talk about. But when I say the numbers make sense, is at a very high level, here's what it means. You take a property in Birmingham, Alabama, as an example. Let's just say it's a $120,000 3-bedroom home, which I've seen plenty of. That property will rent for roughly about $1,200 a month, sometimes a little more, sometimes a little less, but it's about 1% of that purchase price or that value that it'll rent for. We call that the RV or rent to value ratio. So when you have a rent to value ratio close to 1%, it could be 0.8, 0.9, 1.1. That is a quick litmus test or a metric to see if the numbers are going to pan out or pencil out. So you have a good rate of return, good cash on cash return, and good cash flow. Now, you try doing that in San Diego or San Francisco or in Denver, Colorado, or some of the markets in New York or Washington. It's not going to happen. There, you're going to have a $500,000, $600,000, $800,000 home that only rents for about 0.4 or 0.5% of that number. Those numbers are not going to make an investment work properly. You're just not going to have a high cap rate, a high cash on cash return. You may have positive cash flow. You may not. It may not be all that attractive, but you're certainly not utilizing your investment capital to the maximum possible potential. So when you could take $100,000 of investable capital and put it into Birmingham, Alabama, and pick up, let's say, 4 of those properties versus barely getting half of a property in the other markets I just mentioned, San Francisco, Denver, Colorado, the answer becomes clear. And so this is why I say the numbers don't make sense, because you need to have the returns and the cash flow in the right markets to make your investment capital work right and work hard for you.
Let's get into the weeds just a little bit when it comes to those numbers. So you gave the example, $120,000 house, $1,200 rent. It's roughly the 1% rule is what people call that.
Right.
I want to kind of go down 2 rabbit holes with you. That's a little bit in the weeds, but I think that it's important just so you've been doing this long enough. I think you can give some good perspective here. You mentioned the numbers make sense. Are we paying cash for these? Are we getting a loan? What's better in the long term? Should we if we do get a loan, should it be a shorter term so we can cash flow less now, but have them paid for later? Give us your opinion on what we should do there, how we should navigate that.
So let's take that red pill and go down the rabbit hole. See what we find.
But Marco, it is a rabbit hole. I warned people ahead of time. I was getting in the weeds a little bit, but I do think these are the questions that people present to me on almost a daily basis. And you're a professional. You've been in this business for a very long time, and I want to get your professional opinion on what you think about this.
Well, it's a great question, and the fact that people are asking you this question, it proves that it's a really good question. Now, I'm going to guess that a small percentage of those people that ask you that question are listening to people like Dave Ramsey, who's constantly preaching that all debt is bad, debt is bad, debt is bad. That's not entirely true, because you need to look at what is that debt doing for you. There's good debt and bad debt. The bad debt is consumerism, consumer debt. The good debt is what can you use that financing for. And if you can control and acquire an asset that generates passive income for you and grows in value over time, that becomes an incredible strategy, a powerful strategy. And that's the beautiful thing about investment real estate, is one of the 5 big benefits you get from investment real estate is the fact that you can leverage it. What does that mean? It means that I, as a real estate investor, can go to a lender or a broker or a bank and borrow literally up to 80% of that purchase price and put only 20% down, which means that I only have to invest 20%. And remember, that money is not disappearing. It's basically taking it out of your savings account and moving it over here into this property, which is essentially a forced savings plan or savings account. So now I have got my 20% in a property that's generating cash flow and creating equity and wealth over time. And so now I've just basically repositioned my cash. But the benefit of that is I've got 80% of other people's money to acquire that asset. But guess what? I get 100% of the benefits. The bank or the lender doesn't get anything. They get squat other than the monthly mortgage payment. So they're happy because they're making their interest. But I get 100% of the tax benefits. I get 100% of the cash flow, 100% of the equity growth. I get 100% of the appreciation. And I get a return on my money. So if I can do that once, why not do it twice? Why not do it 3 times or 4 or 5 or 10 or 20 or 30? Now I have a portfolio of 30 properties generating $300 a month. That's $9,000 a month in passive income. Can I leave my job and live my life and enjoy my life and travel and be with my family and have free time and do the things I want to do and teach people how to invest in real estate? Well, yeah, because that's exactly what we've done. So the leverage is powerful and allows you to magnify your investment, your returns on your investment, and accelerate the speed at which you create that passive income and build wealth for yourself over time. So when people talk about debt financing for real estate, it's like, hell yeah, how much can I get? How much of it can you stack? Because the more I can get, the faster I'll get to my income goals. Am I answering your question, or I'm not sure?
So the answer is yes. Leverage is a good thing. It's a powerful thing, especially when you're using it when someone else is paying that leverage. That's your answer, it sounds like.
Yeah, at the end of the day, I'm not even paying those mortgages. It's my tenant who's paying those mortgages. They're paying $1,000 a month on my $100,000 property. 100 of it, or 80 to 100 of it, goes to the property management company, which I'm happy to pay for because they're managing my assets, not me. I pay my property taxes, my property insurance. I pay the debt service, which is the mortgage, which might be $500 a month. I'm left with roughly $350 a month net cash flow per door, per property. So now I want to do that more, keep doing it.
So the question I get asked specifically is, how much is too much leverage? Like, what is the definition of over leverage? Is it because it sounds to me like you're advising people to put 20% down because that's typically what a bank is going to require. Are you good there? Like, because over leverage seems to be like an opinion.
Are you talking about being over leveraged on a single property? Like, correct, how much debt on one property, correct, is too much? Well, the way to answer that question, I can answer it 2 ways. If you were able to give me 100% financing on a property, so I put nothing down, just my closing costs, and I'm still cash flow positive on that property, short of a few minor little ifs and conditions, I'd say I'll do that all day long because that's 100% return on my money. No, not 100%. That's an infinite return on my money. Nothing down gives me an infinite rate of return. That's like printing money. I'll do that as often as I can. And the only reluctance I had there, not that I do have any reluctance, the only reluctance I had in that answering that question is this: I want to make sure that if I'm financing a property, hypothetically with 100% financing, that I have a cushion in there. Like, there is some equity just as a cushion. But the most important thing is being cash flow positive with enough cash flow each month and each year that I can weather through real estate cycles or economic storms. Because what will change, we are going to have a recession. We're overdue for one. We're going to see cycles in the economy. We're going to see cycles nationally in any kind of market, whether it's the stock market, the bond market, the quote unquote real estate market. There are real estate cycles at the local level in every single market all the time. So as these things cycle and property values change, I don't want that to affect me. And for the most part, it won't. And why I can say that with absolute confidence is this: if I buy right in the right market and in the right neighborhood where I have a constant pool of tenants, a good, strong rental demand, it's a desirable area where people always want to live, then I know I'll always have a tenant in there that's paying my rent. And if that's the case, and I'm cash flow positive, it doesn't matter what's going on with the local economy, the global economy, with the real estate market, because that property is carrying itself. I refer to as cash flow as glue. It's the glue that holds my real estate deal together. And as long as I've got positive cash flow, then I know all my expenses are paid. I know my debt service is paid. And the property is just carrying itself, and what's left over is mine. It's my cash flow.
So you almost answered, we're setting up this question perfectly, and I think you almost answered it. Because I've heard this too from a lot of pundits, and I think by what I just heard you say is you would even agree that if we're not at the height of the market, we're very close. We're due for a recession, I think is what you just said, or for at least a little bit of a downturn. Is this a bad time to buy turnkey property?
Well, I almost have to push back on that question and ask you a question. So here's where you may already know the answer to this question, but when you say, are we at the height of the market? I'm going to ask you a question. Which market are you referring to?
No, I don't know. I was talking about the real estate market. Okay,
but there's no such thing. And here's why.
All right. I need some education here. Come on.
All right. It's coming at you. So when you listen to the news, right, you read the Wall Street Journal or whatever the case may be, and they talk about the housing market or the real estate market. My question to them is, show me this real estate market. Where's this housing market? Where's the national real estate market? You can't point to it. You can't show me the housing market, the national real estate market, the U.S. housing market. It doesn't exist. Why? Because all real estate markets are local. Every real estate, like what happens in your backyard in Birmingham, Alabama is completely disconnected and different than what's happening
100% agree with that.
In Laguna Niguel, California, right here behind me, right? So what's happening here is not affecting you. The business climate and the economic forces, the supply and demand, the housing prices, the rents that are going on here have nothing to do with your market. And so when people talk about, are we due for a crash? Is there a housing market bubble? You always have to ask the question of which market are you talking about? Because all real estate is local.
Totally.
There are certain things that affect us, on a global basis, like interest rates, like mortgage rates, and jobs, the job environment. But, if you're in a diversified local market, the impact on you and your tenants or your tenant pool is minimized, as opposed to being in a market that is heavily dependent on oil or gas or steel or cars, like the automotive industry. We've seen that happen in places like Detroit. So if you can be in a diversified, balanced market where the fundamentals are strong and you have diversity in the industry, the GDP is spread across multiple industries, then you're going to do well. And this is the top-down approach that I talk about. I call it a funnel approach to investing. So the whole thing about, are we due for a crash or how's the housing market? I can't answer that question because there's no such thing as a national housing market. And that's the problem, if you will, with the Case-Shiller index, when they look at, the housing trends. Well, the problem with that index is it only factors in either 10 or 20 markets as part of that composite index. So it's only tracking 20 of the largest markets in the country. Is it a barometer? Sure, could be a barometer, but it doesn't necessarily mean that what's happening in those 20 markets is happening in my market. In fact, those 20 markets could be flattening out or even depreciating in terms of price, but I could be in a market where there's lots of jobs and strong demand, like Houston or Huntsville or other markets like that, where there's population growth, job growth, and guess what? It's driving up demand, and that demand is driving prices up, and it's driving up rental rates, and I'm thriving. Meanwhile, these other markets are on paper, in the indices, it shows that they're, contracting.
Love it. Marco, I love that. That's awesome. I talk about that all the time. Real estate investing is totally local, especially when you start talking about some of these cash flowing markets. You start talking about these B and C rated media markets like a Birmingham, a Huntsville, you just named, Memphis, Charlotte, some of these other places are a little bit more off the beaten path. Marco, that actually kind of sets up my next question is, you mentioned that you're in specific markets. Tell us from a national perspective, because you are kind of have your toe dipped into all these markets. From a national perspective, where are you seeing the most or some of the most growth in terms of cash flowing real estate, in terms of cash flowing types of markets? Where are people buying cash flowing assets today?
Well, you're almost asking two different questions. Because you're asking, where we're seeing the most growth.
From a cash flow standpoint.
Okay, so
forget that part of it. Then I probably misspoke. Where are people going today to buy cash flowing assets?
Okay, so let's talk about the 2022 markets that we're in right now. Well, not all of them, but I'll mention some of them. So first of all, it's important to know that we won't be in a market and offer turnkey investments in any market unless that market is healthy, sound, and provides positive cash flow. Otherwise, why bother, right? We're investing in real estate to create income, passive income specifically. But we classify markets two different ways. There's generally speaking, two types of markets. We have growth markets and we have income markets or cash flow markets. And then, if you kind of marry the two, you get less of each, but you get a hybrid type market. So markets like Jacksonville, Florida is one of the markets we're in. We really like because it is more of a growth market. Yes, the common denominator is you'll always have positive cash flow. But the question is are you focused on a cash flow market where you have good cash flow, good cap rates and cash on cash returns, and it's really a boring market, but you just get income? Those are like the Memphises of the world, Oklahoma Cities of the world, to a large degree, the Indianapolises of the world, Northwest Indiana. There's other markets as well. Birmingham has been, to a large degree, like that for us. Although Birmingham has been actually experiencing some pretty strong price growth more recently. But then you look at growth markets and you have markets like Jacksonville, Florida, Tampa, Southwest Florida. Kansas City has been for the last 3 years, Kansas City, Missouri has been a very strong growth market. Parts of the Chicago MSA. Anyway, you get the point. It's like you got markets that are appreciating above its historical norm and above national averages. So whenever you see a market appreciating above 5-6% a year, you're getting into growth territory, and that is not sustainable long term. Mm-hmm. But it can be sustainable for a 2, 3, 5, sometimes a 7-year period, and then the market will pull back and take a breather or maybe correct. So you as an investor need to ask yourself, what am I interested in investing in to build my portfolio? And that's going to vary from person to person, and depending on what stage of investing you're in. You might be a newbie and just starting out, and you have a certain criteria. Maybe you just want all cash flow markets, or you want all growth markets because you want to swing for the fences and hit doubles and triples as opposed to just singles. Right. So that's the variation. But I've given you some examples of cash flow markets. I've given you some examples of growth markets. There's no right answer to your question in terms of where to start or what you should invest in, because it really comes down to our conversation with you when we counsel and figure out who you are and where you should be going.
let's go down that route just a little bit. Like what just so people can kind of get a sense of that. What are the conversations that you're having with potential new clients who are looking for passive income in certain different markets? What are some of the questions you're asking them to see where they might fit on that barometer?
Well, in no particular order, it would be, what's your level of experience? Do you have a portfolio now? Do you have any rental properties? If so, how many? Have you been an active real estate investor or a passive real estate investor in the past? What your investment goals are, where are you today, and so that way we can kind of roadmap that from where you are today to where you want to get to, and then you reverse engineer that and map it out into a plan of how many units you need, in what types of markets, what's your risk tolerance. Some people don't even have a risk tolerance. They're fine with virtually anything, and some people are very cautious and skittish, and they're very slow to get started in the beginning because they're just very conservative types of investors. So those are the types of things that we want to find out, we want to talk about, and maybe you aren't even asking yourself these questions, and really we're going to ask the questions that you should be asking yourself to learn about who you are as an investor and what you feel comfortable with. And then we can have discussions about different markets and the different types of neighborhoods and the types of demographics of people that live in those markets and see what you're comfortable with. Yeah, you're not living there, and yeah, you're not managing the property. But I know people that, even though they don't live in these properties. They have just grown up in being in better quality neighborhoods and school districts, and they're kind of the A minus type of neighborhood mentality, and that's what they feel comfortable investing in.
Yeah.
Then there's other people that want to be in the lower income areas, and they're in C-class neighborhoods, and they just happen to like the returns, the immediate returns and the cash on cash returns, and they just want to build their portfolio of that kind of stuff. I call that thick skin investing, because you need to have thicker skin to have a portfolio of those lower income type properties.
To weather some of the potential evictions, vandalism, and some things that could go along with that ride. For sure. We know all too well about that here in Birmingham. You mentioned
Right.
something earlier, Marco. I want to kind of get back to this, kind of like as we start to wrap up here. I want to ask you this. You mentioned that leveraging property is one of the 5 benefits to real estate investing. I want to give you an opportunity. I think this will service some of our listeners. What are the other 4? And these are all of the benefits to owning real estate.
Yeah, so this applies sometimes in slightly different ways to all residential and income-producing real estate.
Mm-hmm.
But generally, it would be this. So first and foremost, and this is, we talk about cash flow being king. It has to do with income. So it's the cash flow or the income you generate from your rental portfolio that is spendable or investable cash that goes into your pocket every month and every month of the year and all year long. So we have income from the property, which is the beautiful thing about real estate, is it generates income, and that grows over time, and it makes you financially free. At some point, you become financially independent. The second is a magical thing, and that is depreciation that happens with investment property. The fact that you can take a deduction on your taxes and lower your taxable income because of the investment that you make in real estate, and do that with residential for 27 and a half years. The IRS has code for this. It lets you do that. Is a powerful thing, because I don't have to spend a single penny in order to get that depreciation write-off, that write-off against my passive income. And if you're a professional real estate investor, you can apply that towards your active income as well. So it's a beautiful thing. You can't do that with any other asset class other than oil and gas. And as of the last tax bill that got passed by Trump, he has now made real estate the most tax favored asset class in the country. So real estate is the best investment. Thirdly is what happens over time is your tenants are paying your mortgage payments every month and every year. And as you pay those mortgage payments, you're amortizing your debt, your loan on the property. So guess what? Every month, you have a little bit more equity in that property. And as the months go by and the years go by, the equity that you have in that property continues to grow, because guess what? Your tenants are paying down your mortgage for you. So you have equity growth in the property. You have this, what I refer to as amortization. That's the fancy word for just equity growth. Okay, so the fourth benefit is appreciation. And so over time, properties well purchased will appreciate. And the reason for that is because properties are made up of commodities. Essentially, they're sticks, bricks, concrete, and copper. And they're all put together into something we call a house or a property, and it's sitting on a hunk of land. But over time, because we live in an inflationary environment, and that's just a part of our economic system, is we're going to see property values go up simply because of inflationary effects. We live in an inflationary monetary system. And I'm not talking about increased demand for housing. That also is a form of appreciation, because if you have strong demand in an area and a shortage of supply, naturally what's going to happen with supply and demand is it's going to push property values up and push rents up. So you're going to see property values go up as well. So part of it has to do with our economic environment, the economic model that we have in this country. And the other part of it is just simple economics, supply and demand. But properties do tend to appreciate, depending on the area, anywhere from 4 to 7% per year on average. And it does cycle, yes, but over time, history has proven time and time again that property values will increase. And as long as we have a growing population, that's going to continue to go on. And then last but not least is what we spent time talking about before, and that's the power of leverage, the fact that you could borrow other people's money and invest and put as little as 20% down of your savings and leverage your returns and grow your portfolio and keep doing that over and over and over again.
That's awesome. I've never heard appreciation broken down that way into kind of almost like you've got it broken into two little buckets there. One is just our economic model, which is what you kind of put it as. And the other is just simple, supply demand economics. So I've never heard of that before. That's really interesting. I guess there's probably no way, I'm kind of asking, there's really no way to know which one you're getting a benefit from at any one point.
Well, let's just say you have complete equilibrium in your local market, which is impossible. But let's just say that everything is in complete balance, supply, demand, nothing is changing prices because of local factors. If that were true, the only thing that's changing is the cost of goods to build new product, if and when you build new product. So if copper prices and concrete and lumber, if those prices are going up, then the intrinsic value of your property has to go up, because if it burnt down and you had to rebuild exactly the same thing that you just had, it would cost more to build that structure. And if it costs more, then the argument is that it has a higher value. The value of that property is higher. So that's why, if property values have to go higher in an inflationary environment.
It's interesting. Well, Marco, I can't thank you enough for coming on the show. It's been super educational. I think that a lot of our turnkey buyers, our turnkey listeners got tons of value out of you coming on the show. I really do appreciate it. For those that might want to get in touch with you, might want to listen to your podcast, tell everybody where they can hear from you and get in touch with you.
Yeah, thank you. Thanks for asking. So if you're interested in the podcast or the content we put out for free related to all that, it's at passiverealestateinvesting.com. Very simple domain name. Same name as the show, passiverealestateinvesting.com, and everything's white, black, and red. Same thing with our real estate, just like your logo in the background there. Actually, you have the same color scheme. Great minds think alike, huh?
There you go.
Yeah, and so our main website where we post properties every day, they come and go, is noradarealestate.com, Norada, noradarealestate.com. That's our main website. We're rebuilding it right now, so it'll be new and improved very soon, but that's where you can find my team and I and everything you could probably want. So
awesome. And you got a book coming out? When and how can we find out about that?
The expected release is in 2 months. So we're in we're in May, June, July. So mid-year, around July.
Okay.
Is the release.
Let us know, and we can post the link for you to our audience as well. And we'll put all your links in our show notes. So guys, if you're driving down the road right now listening, don't feel like you got to break your neck to write something down. You can just go back and look in the show notes to get in touch with Marco. And then we'll link up your book. When you put your book out, we'll be glad to link it up.
Yeah, there's going to be a free version of it too. So I'll make sure you get that. There's a free version of it.
Very cool. Marco, thank you again so much for coming on the show. Really do appreciate it.
Thank you, Brian. I really appreciate it. Thanks so much.
Guys, we love you so much. Make sure you hit that subscribe button so you get alerts for our next shows. We love you. We'll see you next time.